We're back for another episode of Tax VAR where we hand out red cards, yellow cards, or we can agree with the on-field decision because sometimes the advice is actually good. We gotta remain impartial. We got a new video. Let's hop into it.
There's a massive difference between somebody who makes $1 million a year from their job versus somebody who's making $1 million a year in their business profit, by the way, because of how you get taxed. If you make $1 million a year as a W-2, that million has gone down to $500,000. Versus if you're a business owner, you can offset a lot of your taxes and you can end up paying 10, 20, 30% instead because you offsetted your taxes with write-offs, investments, and depreciation, things like that. So by the end, the business owner ends up being able to keep more cash to themselves versus the W-2 employee that was making $1 million a year.
For the most part, this is true. When you have a business, you can leverage deductions to offset your taxes. But he lost me a little bit when he was saying that we're comparing $1 million in salary versus $1 million net profit in a business. So at that point, it wouldn't be the tax deductions that get you paying a lower amount of tax. It would actually be the entity structure that comes with a business. And why tell you when I can show you? All right, we're here in our tax modeling software. We're going to do a Canadian example. We're going to keep Kevin's example. On $1 million in salary at the corporate level, because they don't have a business, we're going to clear these fields out as well. If we go to their combined scenario, they're going to have an effective tax rate of 43%. Now, what if you're earning $1 million from the business? This is very important. If you're earning $1 million from the business, a wealthy business owner still needs to pay themselves a salary. Rarely will you find a business owner that strictly pays themselves distributions because it usually leads to double taxation. You want to find a mixture of salary and dividends. Usually you'll find that a salary is being paid for necessities. On average, it's around $70,000. If we are earning $1 million of revenue within the corporation, but we do issue ourselves a salary of $70,000, we are left with $930,000 of taxable income, which when we look at our combined situation, we're saving over half of our tax owing just off of having a business. As for the VAR verdict on this video, I'm going to agree with the on-field decision. He's paraphrasing here and there, but for the most part, this is accurate tax advice. Great job there. If you are enjoying this type of content and want to see more critical VAR reviews where we legitimize tax advice on social media, make sure to drop a follow. I'll see you guys in the next video.